Hi, my name is Professor Deanna Martin, and today we're going to talk about the first step in the accounting cycle, which is to analyze a transaction. Now, let me remind you what's on the accounting equation. We're going to start with assets equals liabilities plus owner's equity. As a reminder, assets is what the company owns. Liabilities is what the company owes. And then owner's equity records what the owners have as a claim on the assets. As a reminder, a couple of things we're going to see under assets. We'll always start with cash. Another common one that we'll see is accounts receivable. Another common one is supplies. And we'll get into our long-term assets like building and equipment. The assets do need to be prepared in the order of liquidity. Cash is always first. As a reminder, AR stands for accounts receivable. Your payables are going to go in the liabilities section. Probably the two most common are accounts payable and notes payable. Accounts payable will be paid in 30 to 60 days, and notes payable a little bit longer than that typically, and it could even be years, and we would call that probably a mortgage payable. The weird one in there is unearned service revenue. Our owner's equity section will be affected by owner's capital. The owner's capital will be increased by investments. It will be increased by net income or decreased by a net loss. I'll put that as in parentheses for a negative number. And the net income and net loss comes from an increase from revenues or decrease in expenses. And lastly, we would see a decrease in owner's capital from drawings. That's when the owner pulls money out of the business. Knowing that is going to help you understand the basis for analyzing a transaction. Every time you read about a transaction, you want to think about what accounts are affected, what are the amounts that'll be given to you, maybe a little bit of computation, and is it an increase or a decrease? So the three things you need to think about are accounts, amounts, and increases or decreases. So let's take a look at an example. We need to remember also that our accounting equation needs to balance every time you do a transaction. So I'm going to rewrite that here. Let's take a look at a couple examples. The first one is the owner is going to invest cash in the business. So cash is under assets. The amount would need to be given to you. Let's say it's $10,000, and that is going to be an increase. The owner will record that as an investment, which is under owner's equity. So the account is investment in the owner's capital account, and that'll be an increase of $10,000. So cash is going to go up, owner's equity is going to go up. You need to make sure your accounting equation is in balance every time. The left side goes up, the right side goes up, we're good. Let's take a look at another example. Let's say the owner would like to use some of that cash to invest in some equipment. So the cash is now going to go down. So the account is cash, and it's going to go down, let's say $2,000, just going to buy a computer, for example. The other side of this would be the equipment. Equipment is also an asset, and it would go up $2,000. We notice in this case that both the plus and the minus are on the same side of the equation. So in this case, assets goes up and down, and it balances each other out. We're still in balance in our accounting equation. Let's take a look at a couple more examples. Another example is that we open for business and a customer says, I would like to buy your services. So we have to decide, are we getting paid now or later? So you look for that in the given information. In this example, let's say the customer is going to pay us now. So we're going to see cash go up. Cash is under the asset section. Let's say that services were in the amount of $1,000. That would need to be given to you. Cash is going to go up for $1,000. The other piece of that is going to be under owner's equity because revenues is under owner's equity. So the other account is going to be specifically service revenue, and that amount will also go up $1,000. Once again, left side goes up, right side goes up, we're in balance. Now let's say we want to pay the salaries to the people who worked on those services. So we're going to pay that with cash right now, just going to keep it easy. Our accounts are cash, which is going to go down, let's say $500. And then the other side of that is salaries and wages expense. The expenses affect owner's equity, so over in owner's equity, we're going to see expense. In this case, salaries and wages expense, and that is going to be a negative $500 because expenses are always going to be a negative effect on owner's equity. This represents a negative effect in owner's equity. So now in this case, we see assets go down, owner's equity go down, both sides of the equation goes down, and we're still in balance. Let's take a look at a couple more examples. Our next example is, let's say a customer says, I would like your services, but can I pay you next month? We'll say, sure, no problem. Well, we're still going to record the revenues. So the revenues will be right here. Let's say this is for $700. Given information, revenue will be going up, even though we haven't collected the cash. The account that records cash to be received later is under here. AR, accounts receivable, it is going to go up $700. Then next month happens and the customer is going to pay off some of that accounts receivable. So cash is going to go up. Let's say they're not going to pay all of it. They're just going to pay $200. So we're going to increase $200. And then the other account is right there in accounts receivable. Accounts receivable is going to go down $200. We see the asset section going up and down at the same time. We're still in balance. Let's take a look at a couple more examples. Another example is, let's say we just received a bill in the mail. We need to pay our electric bill. We're not going to pay it now, so cash is not a part of this, but we are going to pay it later, and we're going to record the expense for that one. So the liabilities section is where we're going to record the accounts payable, abbreviated AP, and let's say the electric bill is $100. Our liabilities are going to go up $100 because that's the amount of bills that we owe. The amount we owe just got higher. We're going to increase that for $100. And then the other half of that is going to be expenses. Expenses are recorded here. In this case, we would probably call it something like utilities expense or something like that. And that is going to go down $100 because expenses always go down because expenses are negative on owner's equity. Now in this case, we can see that liabilities go up, owner's equity go down. They're both on the same side of the equation, so the equation is still in balance. One last example. Let's say that owner would like to take some cash out of the business for his own personal use. Cash is over in the asset section, and let's say the owner took out $300. We're going to see negative $300. The other half of that is going to be in drawings. It's also always negative. It's under owner's equity. So the drawings account, we need to show that transaction of $300. We can see the left side of the equation goes down, the right side of the equation goes down, so we're still in balance. I hope that helps you with analyzing transactions and how it helps you learn how to keep your basic accounting equation in balance all the time. Thank you.